The most powerful asset we all have is our mind. Robert Kiyosaki. This quote encapsulates the essence of Robert Kiyosaki's philosophy, one of the most influential figures in global financial education. Author of the bestseller Rich Dad, Poor Dad, Kiyosaki revolutionized how millions of people view money, investments, and wealth building. But why are his ideas so relevant today, especially as we look toward the future in 2025? We live in a world of constant transformation, where the global economy faces challenges such as inflation, technological changes, and geopolitical uncertainties. In this scenario, understanding how to invest wisely is not just an advantage, it's a necessity. And that's where Kiyosaki's lessons become indispensable. In this video, we'll explore Robert Kiyosaki's 10 rules for wealth creation in 2025. These rules aren't just theoretical, they are practical, tested, and proven by thousands of people worldwide. Whether you're a beginner investor or someone who's been in the market for a while, this content will motivate and teach you how to make more assertive financial decisions. In the next few minutes or hour, you'll discover how to differentiate assets from liabilities, why financial education is the foundation of everything, how to use debt to your advantage, and much more. Our goal is that by the end of this video, you'll walk away not only inspired, but also with a clear plan to apply these rules in your life. So, get ready for a journey that could transform your relationship with money. Let's begin. Rule 1. Know the difference between an asset and a liability. If there's one lesson Kiyosaki repeats tirelessly, it's this. To build wealth, you must understand the difference between an asset and a liability. It sounds simple, but many people confuse these concepts. And that confusion can be costly. An asset is something that puts money in your pocket. Think of rental properties, dividend-paying stocks, or a profitable business. These are classic examples of assets because they generate regular income without requiring you to work actively for it. On the other hand, a liability is something that takes money out of your pocket. Luxury cars, personal loans, and even the home you live in, unless it generates income, can be considered liabilities. This is because they incur expenses like maintenance, taxes, or loan payments. Kiyosaki emphasizes that the key to wealth is acquiring assets and reducing liabilities. For example, instead of buying a new car that will only depreciate, you could invest in a rental property that generates monthly income. The choice is yours, but understanding this difference is the first step toward making smart financial decisions. Here's a practical challenge. Grab a piece of paper and list your assets and liabilities. How many of them are putting money in your pocket, and how many are taking it out? This reflection could be the starting point for a significant change in your financial life. Now that you know the importance of differentiating assets from liabilities, let's move on to the next rule, which is equally crucial. Investing in financial education. Rule 2. Invest in financial education. If you want to build wealth, there are no shortcuts. Financial education is the foundation of everything. Kiyosaki often says, "Money without financial education disappears quickly." And he's absolutely right. Many people dream of getting rich, but few are willing to invest time and resources to learn how money really works. Financial education isn't just about knowing how much you earn or spend. It involves understanding concepts like cash flow, leverage, taxes, and, of course, the difference between assets and liabilities. The author believes that the greatest investment you can make is in yourself. This means reading books like Rich Dad, Poor Dad, taking courses, following podcasts, and seeking mentors who have already achieved the success you desire. The more you learn, the more tools you'll have to make smart decisions and seize opportunities. A practical example. Imagine you want to invest in real estate. Without knowledge, you might end up buying a property that only brings headaches. But with financial education, you'll know how to evaluate its income potential, calculate costs, and even negotiate better terms. The message here is clear. Don't wait to have money to start learning. Start now with the resources you have. And remember, every book you read, every course you take, and every mentor you follow is a step toward financial freedom. If you're ready to take the next step in your financial journey, we have something special for you. From step-by-step guides to comprehensive investment courses, our products are designed to simplify complex concepts and guide you toward financial independence. Want to learn more? Click the links in the description and discover how our info products can accelerate your journey. Remember, knowledge is the first step, but action is what brings results. Don't let this opportunity pass you by. Start transforming your financial life today. Rule 3. Focus on cash flow, not just appreciation. One of the most common mistakes investors make is focusing solely on an asset's appreciation or how much its value may increase over time. Kiyosaki, however, reminds us that the real power lies in cash flow. What is cash flow? It's the regular income an asset generates, such as rent from a property, dividends from stocks, or profits from a business. While appreciation depends on external factors like the market, cash flow is within your control, and it's what will ensure money keeps flowing into your pocket month after month. Let's look at a practical example. Imagine you buy a house with the intention of selling it later at a higher price. While you wait, you'll need to cover taxes, maintenance, and other expenses. Now, consider another scenario. You buy a house and rent it out. In addition to potential appreciation, you receive monthly rent that covers expenses and generates profit. Which option seems safer and more sustainable? The author emphasizes that cash flow generating investments are the key to financial independence. They provide passive income, which can be reinvested or used to cover your expenses, reducing the need to work actively for money. Of course, this doesn't mean you should ignore appreciation. A good investment combines both. It generates regular income and has the potential to appreciate. But the primary focus should be on cash flow because it provides stability and freedom. Now that you know the importance of prioritizing cash flow, let's move on to the next rule, which will show you how using debt wisely can accelerate your journey toward wealth. Rule 4. Use debt wisely. When we talk about debt, many people's first reaction is fear or rejection. After all, debt is often associated with financial problems. However, Kiyosaki teaches us that not all debt is created equal. The key is knowing the difference between good debt and bad debt. Good debt is debt you take on to invest in assets, things that will put money in your pocket. For example, taking out a loan to buy a rental property that generates monthly income. In this case, the debt is working in your favor because the rent covers the loan payments and leaves you with profit. Bad debt, on the other hand, is debt used to buy liabilities, like financing a luxury car or paying bills with a credit card. These debts only take money out of your pocket without generating any financial return. The author emphasizes that debt can be a powerful lever for wealth creation, but only if used wisely. He himself has used loans to acquire properties and businesses that generate consistent cash flow. The secret is ensuring that the return on investment is greater than the cost of the debt. For example, if you take out a loan at an 8% annual interest rate to invest in a property that generates a 12% annual return, you're making a 4% annual profit just by using debt wisely. The message here is clear. Don't fear debt, but use it strategically. Invest in assets that generate enough income to cover the payments and leave you with a profit. Now that you know how to use debt to your advantage, let's move on to the next rule, which will show you how diversifying your investments wisely can protect and grow your wealth. Rule 5. Diversify, but wisely. You've probably heard the advice, don't put all your eggs in one basket. That's the essence of diversification, a strategy Kiyosaki also advocates. However, he takes it further. Diversification is important, but it must be done wisely. Smart diversification means spreading your investments across different types of assets, such as real estate, stocks, businesses, and even precious metals, but always based on knowledge and strategy. The goal is to reduce risk, as different assets can behave differently during times of crisis or economic instability. For example, imagine you have all your money invested in a single company's stock. If that company faces problems, your wealth could be severely impacted. Now, consider another scenario. You have investments in rental properties, stocks from different sectors, and a small business. If one of these assets underperforms, the others can compensate for the losses. The author stresses that diversification shouldn't be done randomly. You need to understand each type of investment and how it fits into your financial plan. For instance, real estate can offer steady cash flow, while stocks can bring long-term capital gains. The key is to balance these assets according to your goals and risk tolerance. Additionally, he warns that over-diversifying can dilute your returns. Investing in dozens of assets without a clear purpose can make you lose focus and fail to track each one's performance. The message here is clear: diversify, but with purpose and knowledge. Choose assets you understand and that align with your wealth-building strategy. Now that you know how to diversify wisely, let's move on to the next rule, which will show you why investing in real assets is one of the best ways to protect and grow your wealth. Rule 6. Invest in real assets. In a world where the economy can change rapidly and currencies can lose value, Kiyosaki argues that investing in real assets is one of the best ways to protect and grow your wealth. But what are real assets? Real assets are tangible items with intrinsic value, such as real estate, land, precious metals, gold, silver, and even physical businesses. Unlike financial assets like stocks or bonds, which can be abstract and subject to market volatility, real assets tend to be more stable and resistant to economic crises. For example, during periods of high inflation, the value of money may fall, but the value of real estate or a gold bar tends to hold or even increase. This is because these assets are tied to something concrete and limited. They can't be printed or created out of thin air like money. The author also highlights that real assets offer multiple benefits. A property, for instance, can provide cash flow through rent, appreciation over time, and even serve as a hedge against inflation. Gold and silver are seen as safe havens during times of financial instability. But it's important to remember that investing in real assets requires knowledge and planning. Buying a property without analyzing its location, appreciation potential, and maintenance costs can turn it into a liability, not an asset. Similarly, investing in precious metals without understanding the market may not yield the expected returns. The message here is clear: real assets are an essential part of any wealth-building strategy, but they must be chosen carefully and aligned with your financial goals. Now that you know the importance of investing in real assets, let's move on to the next rule, which will teach you how to handle risk intelligently and proactively. Rule 7. Learn to manage risk. One of the biggest myths about investing is that avoiding risk is the key to success. Kiyosaki, however, teaches us that risk is inevitable. The real skill lies in learning to manage it. Risk is part of any investment. Stocks can fall, real estate can depreciate, and businesses can face crises. But instead of fearing risk, the author suggests embracing it as an opportunity for learning and growth. The first step in managing risk is understanding it. Before investing, ask yourself, what's the worst-case scenario? If you're buying a property, for example, consider factors like vacancy, periods without tenants, maintenance, and market fluctuations. If you're investing in stocks, evaluate the company's financial health and industry conditions. Another important strategy is diversification, as we saw in the previous rule. By spreading your investments across different asset types, you reduce the chance of losing everything in a single bad decision. The author also emphasizes the importance of having an emergency fund. This fund acts as a safety net, allowing you to face unexpected expenses without needing to sell your assets at unfavorable times. Additionally, he recommends never investing money you can't afford to lose. This means setting aside a portion of your capital for higher risk investments, like businesses or stocks, and keeping the rest in safer options like real estate or precious metals. The message here is clear. Risk isn't your enemy, it's part of the game. The key is managing it with knowledge, planning, and a mindset prepared for the unexpected. Now that you know how to handle risk, let's move on to the next rule, which will show you why building a team of experts is essential for investment success. Rule 8. Build a team of experts. Kiyosaki often says that no one can be an expert in everything. That's why one of the most important rules for building wealth is assembling a team of experts who can assist you in different areas of investing. Imagine you're buying a property. Beyond understanding the market, you need to deal with legal issues, financing, taxes, and potential renovations. Alone, this can be overwhelming. But with a team of experts, like a real estate agent, lawyer, accountant, and architect, you can make safer and more efficient decisions. The author emphasizes that a good team can accelerate your success. An accountant, for example, can help you reduce taxes legally, while a financial advisor can guide you on how to allocate your resources strategically. A mentor with experience can share valuable lessons that help you avoid common mistakes. But how do you build a reliable team? Start by seeking recommendations from people who have already achieved the success you desire. Research the reputation and experience of professionals, and don't be afraid to ask questions to ensure they share your values and goals. Another important point is recognizing your limitations. If you don't understand tax laws, for example, don't try to do everything yourself. Hire an expert. This not only prevents future problems, but also frees up your time to focus on what you do best. The message here is clear. You don't need to know everything, but you need to know who does. A team of experts isn't a cost. It's an investment that can multiply your results. Now that you know the importance of building a team of experts, let's move on to the next rule, which will show you why thinking long-term is essential for sustainable wealth creation. Rule 9. Think long-term. In a world where many seek quick results, Kiyosaki reminds us that true wealth is built over time. The 9th rule for wealth creation is simple but powerful. Think long-term. Many people fall into the trap of chasing immediate gains, like investing in fleeting trends or speculating in the stock market. While these strategies may bring quick returns, they also carry a high risk of losses. The author argues that financial success requires patience, discipline, and a clear vision of the future. A classic example is real estate investment. While some people buy properties just to flip them quickly for profit, Kiyosaki recommends focusing on properties that generate consistent cash flow, like rentals. Over the years, these properties not only pay for themselves, but also appreciate, providing solid wealth and consistent passive income. Another example is the stock market. Instead of trying to time the market to buy low and sell high, the author suggests investing in solid companies and holding those stocks for decades, benefiting from compound interest and reinvested dividends. The key here is having a plan and sticking to it, even when the path seems slow or challenging. Kiyosaki emphasizes that time is your greatest ally. The earlier you start investing, the more time your assets have to grow and multiply. Additionally, thinking long-term allows you to face crises with more peace of mind. Markets rise and fall, but those with a solid strategy and a future-focused mindset can weather the storms without losing direction. The message here is clear. Wealth isn't a sprint, it's a marathon. Adopt a long-term mindset, and you'll reap consistent and sustainable rewards. Now that you know the importance of thinking long-term, let's move on to the final rule, which will show you how being an opportunity creator can transform your financial journey. Rule 10. Be an opportunity creator. The 10th and final rule of Kiyosaki's wealth creation is perhaps the most transformative. Be an opportunity creator. While many people wait for opportunities to fall into their laps, the author teaches that true investors create them. This means adopting an entrepreneurial mindset, always looking for ways to add value and solve problems. For example, instead of waiting for the real estate market to improve, an opportunity creator might identify an undervalued property, renovate it, and list it at a competitive price, generating profit. Kiyosaki also emphasizes that the best opportunities often arise during times of crisis. While most people panic and sell their assets, opportunity creators see the chance to buy quality assets at low prices. This is how he built much of his own wealth, acquiring properties during economic recessions. But how do you develop this mindset? First, always be learning. The more you know about different markets and strategies, the better equipped you'll be to spot opportunities. Second, stay connected. Networking with other successful people can open doors you never imagined. And finally, be courageous. Creating opportunities often requires stepping out of your comfort zone and taking calculated risks. The message here is clear. Don't wait for opportunities. Create them. Be proactive, think outside the box, and always be ready to act when the right moment arises. We've reached the end of our journey through Robert Kiyosaki's 10 Rules for Wealth Creation in 2025. Let's quickly recap. Know the difference between assets and liabilities. Invest in financial education. Focus on cash flow, not just appreciation. Use debt wisely. Diversify, but wisely. Invest in real assets. Learn to manage risk. Build a team of experts. Think long-term. Be an opportunity creator. These rules aren't just theoretical concepts. They're practical tools you can start applying today. Remember, wealth isn't a destination, it's a journey. And every step you take toward financial education and smart investing brings you closer to the freedom and security you desire. Now it's your turn to act. Choose one or two rules that resonated most with you and start implementing them. Subscribe to the channel for more content like this. Leave a comment sharing which rule you like the most, and share this video with someone who also wants to transform their financial life. Don't work for money. Make money work for you. Robert Kiyosaki. That's the essence of everything we've discussed today. Wealth doesn't come from hard work, but from smart, consistent decisions. Thanks for watching. If this content made sense to you, don't forget to like, share, and subscribe to the channel. Until the next video, where we'll continue exploring strategies to help you achieve financial independence. And thank you for watching. More videos coming soon, and see you next time, my friends.